interest rates are going to rise without the Bank of Canada even hiking. So how is that going to work? First of all, I want to thank Grant for bringing this article to my attention, because I think it is really, really interesting to think about this and really think through what's happening right now. Okay, so interest rate tightening is now only starting to get real. Now, I can't put the article on here. You can go read it if you've actually got a Globe and Mail subscription, but Grant sent me the article and it was interesting to really read what they were saying there, because essentially they were talking about the inflation rate, which you have right here, and it is coming down right now. So consumer price inflation is coming down, particularly the CPI. I mean, inflation is still massively, massively high. This is still a totally bogus number, but still this means something when we're talking about this, and it does mean something for the real inflation rate, even though it's way higher than this CPI is telling us, or the CP lie, as I like to call it. So anyway, you look at that. So inflation is coming down. Right now it is at 5.9%. So it's come down to 5.9% from 8%. So you're talking about 2.1% of decline in inflation. At the same time that that's been going on, the Bank of Canada has continued to hike interest rates, and now they've paused, but they hiked rates all the way up to 4.5%. So now you've got rates that have gone up, and you've got the gap closing essentially between inflation and interest rates. So that actually means that money is getting tighter. I mean, even if you don't believe that CPI, and I don't believe that CPI, by the way, it's still a fact that money is actually getting tighter. So even though the Bank of Canada isn't hiking rates right now, if consumer price inflation continues to go down, then you will actually see more of a tightening that goes on in the real economy. Because think about it, that means inflation is coming down, and investors are going to be looking at the real interest rate that they're paying, and that real interest rate it's getting closer to becoming positive, even if it stays negative. So that means that the interest rates are actually changing, and people's psychology on return on investments, for instance, that will change, because people will think, well, actually, yeah, I'll go and buy a government bond that's at 4%, because if I go and buy that government bond at 4% and inflation is now 5%, then, you know, it's not that bad compared to last year when inflation was at like 8% and the government bond was at 3%, because then you realize that there is actually additional tightening that's going to go on if consumer price inflation comes back down. So that's really something to bear in mind. And even though the CPI, as you guys know, is completely bogus, this is our favorite shadow stats chart, which shows the 1980s based CPI. This is in the US, but it's the same story in Canada, guys. Doesn't change, same shit, different government. And basically you can see there the CPIU, which is the red line, you can basically see how it peaked at around 9% or wherever it was, and then the actual 1980s based inflation rate, it also peaked at the same time, just at a higher rate. So we know, yes, the CPI is completely bogus. It's no accurate representation of what's going on in the real economy. And really, you have to think about real wage growth with the CPI this elevated, because the reality is the blue line is closer to reality than the red line. So that means people's wages are actually more negative than they even realize. So if they're not doing budgeting, which we know most people don't do, then they have no idea that their purchasing power is actually being eroded. And we know this for a fact because credit card debt has risen essentially like 15% year over year. So that kind of shows you that the extra that people are paying for consumer price inflation, they're just putting it on credit. They're putting it on a credit card. And that is how they're able to keep up the same lifestyle that they have and had during 2020 and 2021, when the government was issuing all this free stimulus money, and essentially that was coming in many different forms. It was coming as the Canada wage subsidy, it was coming as all the rent subsidies. There were so many programs that were out there and were providing direct payments to people. And even now, provinces like Alberta, BC, Manitoba, Saskatchewan, Nova Scotia, New Brunswick, they're all providing stimulus. And in Alberta and Saskatchewan, these are some of the widest and most broad stimulus programs that you can see. It's basically just pretty much 75% 95% of the population is getting a check from the government. So again, that hasn't even ended. And I think that will explain why provinces that have those programs will likely see inflation remain higher. And Alberta is a place which has seen higher consumer price inflation than other places. So it's really, really interesting to think about this. And once again, I just want to go over this again. So what I'm essentially saying here is that you've got the interest rates that are at 4.5%. And let's say we are 3-4 months ago when they had interest rates at 3% and when inflation was at 8%. So when that happens, you're talking about a 5% difference. But now you have inflation at, let's call it 6%, and then you have interest rates at 4.5%. You've only got that 1% difference. So that makes a huge difference because it means the chance of money going into different assets changes drastically, and the allocation of money changes drastically. And you know, that can affect credit and lending, and it can affect many different things because quite frankly, a lot of people can go into government debt, which is pretty much risk-free. So a lot of people will buy that because they know it's essentially risk-free. They're getting a risk-free return of 4.5%. Inflation's coming down, probably going to come down even more. So why am I going to go and invest in real estate? Why am I going to go and invest in a real business when I can get that kind of return just by putting it into 1-year treasuries, essentially? And they could get an even better rate in the US, and the US is a safe haven currency. So that is going to affect things, and that means money is going to get tighter within the economy, and liquidity is going to be hard to find. And that is essentially what I expect to see over the next 6 to 12 months. And probably within that time frame as well, you're going to have a banking crisis. And we're already seeing the banking crisis has started. Believe me, it's just the start. It's nowhere near finished. So we're going to see lots of things that are going to take place over the next 6 to 12 months. More and more red flags. I think we'll see the stock market churn up until it eventually meets its ending point where it crashes. But I think we're going to see a lot more red flags that are going to play out over the next 6 to 12 months. We're seeing the economic data that comes in and it's looking weak. It's looking bad. And the central planners, they're just looking at things that are massively laggy, like unemployment. They're focused on those type of metrics. So we know the central planners are always wrong. The central planners are always too late. And that is just the fact of the matter. So I think this is incredibly important to think about. I want to thank you, Grant, for sharing this with me. Leave a comment below. This is incredibly important, I think. And I think a lot of people need to really rewatch this video and just understand what I'm saying, or just go to that article that I'll link in the description and take a look there. But anyway, I want to thank you so much for watching. If you've enjoyed this video, you might like either of those videos, and I will see you in the next one. Take care of yourselves, guys.